In this video, we're going to have a look at the taxable income framework. This framework is very important as it forms the foundation for calculating income tax. The framework will also help you to integrate the different topics that you're going to study. So as you begin each learning unit or begin looking at each new topic, you need to ask yourself where it fits into this framework. This will help you keep the big picture in mind. It should also help you understand at each stage where the content that you're looking at or the topic that you're learning about fits into actually calculating a person's taxable income and their tax liability. Every topic that you're going to deal with for individuals will fit somewhere into this framework, except for when we look at prepaid taxes or estate duty and donations tax. Those are two different taxes and they're not income tax per se. So the taxable income framework starts with, the framework does, but also the calculation of taxable income begins with gross income. Now, if an amount does not form part of gross income, then it won't be taxed for income tax, other than capital gains tax, which we'll look at a bit later. So if we start with gross income, to find out whether an amount is going to be included or in gross income or not, you will need to know the definition of gross income. And we'll look at this in one of the learning units. And the definition is a defined term, but it also has a list of specific inclusions that are specifically included in gross income for tax purposes. The only other way that amount might be taxable, as I've already said, is in terms of capital gains tax. So after all other amounts have been included in, after all amounts have been included in gross income, either through the definition or because of one of the specific inclusions in the Act then provides for specific exemptions. Now, exempt income is income that has been included in gross income. But the Income Tax Act, in terms of Section 10, provides that this income is not subject to income tax and it must then be excluded. This means that the amount must first be included in terms of the gross income definition, and then it is excluded because of its nature, because Section 10 in the Act says it's not taxable, provides that it's not taxable. Sometimes the exemption in Section 10 only makes provision for a part of income to be exempt, and at other times income from specific transactions or from certain types of taxpayers are fully exempt from tax. But the most important thing that you need to remember at this stage is that the exemption can only exempt income that has been received by the taxpayer, and that you can never exempt more than what was received. Please also note the terminology that I'm using when I refer to income or exempt income. I talk about the amount being included or taxable or exempt. You can't refer to income as being deductible. That's a term that we use when we get to expenses. Also remember that if an amount is not taxable or it is exempt, you need to supply the correct reason for this when attempting a written question. So where there's a nil amount, you need to have a reason why there's a nil amount. Now, gross income, as you can see on your screen, less exempt income gives us income. These are defined terms, so we need to refer to them by their proper defined terminology. Now, the Act provides that once income is calculated for the taxpayer, that they must then include any taxable capital gain. And we will have a look at that in a separate learning unit, a separate topic, so that you learn to calculate taxable capital gains, but it's at this point in the framework that they will be included. And then the last step in calculating taxable income is that the taxpayer is allowed to, or entitled to in terms of the Act, to deduct certain expenses that are provided for. In tax, we refer to these as deductions. The deductions have to be done in a specific order, as some of the deductions are limited to an amount or a total which comes before that deduction. So if you do the deductions in the wrong order when calculating taxable income, then you could be applying incorrect limitations to the deductions. So it's important that you do it in the correct order, and that donations to public benefit organizations are the very last deduction that takes place in the taxable income calculation, and that just before them, if there's been any contributions by the taxpayer to a retirement fund like a pension fund, provident, or retirement annuity fund, that those are deducted just before the donations. And we'll deal with all of these later in the in the learning units. So it's just at this stage to get an idea of the framework and how it all fits together. Okay, so once the allowable deductions have been deducted, that will then give us taxable income of the taxpayer. It's also important that you, again, I just want to re-emphasize the terms that I have mentioned here in this video. Gross income, exempt income, income, taxable income, they're all important terms. Remember that in a question you could be asked to calculate only gross income, you might be asked to calculate income, and you might be asked to calculate taxable income. All of them can be used to express to you what we're looking for in your solution. So you'll see as we work through the questions, these terms are used in the required parts of the questions, and it will give you guidance as to what we expect from you. Remember, if we ask for tax liability or normal tax, you'll have to do more than just the taxable income calculation, and we'll deal with the calculation of normal tax and final tax liability in another video.